Good afternoon, Facebook, and happy Friday. I'm Jill Malandrino, Global Markets Reporter for the Nasdaq, and this is ETF Fridays for this series of Trade Talks. And we know you love your iPhone and your Xbox. Who doesn't love to be lazy on the couch and binge watch the hottest new series? You can support the products you love not just by purchasing them, but by also investing in the sectors like technology that Apple, Microsoft, and Netflix are part of through electronic traded products. And this is a trend that the savvy millennial crowd is increasingly turning to. There's one thing millennials drive, it is trends. Investing is not just for your grandparents sitting behind the massive oak desk of their broker anymore. The Nasdaq stock market is the largest U.S. equity exchange by market share, and we work with several high-profile issuers to launch and switch new products over. In 2016, we led U.S. listing exchanges with 38% of the U.S. ETP listings and switches. Now, joining me today is Eric Balchunas, author of the Institutional ETF Toolbox, which is available on Amazon.com. He is also a senior ETF analyst and funds product specialist at Bloomberg. Together, we will be hosting a quarterly show featuring Eric's research and insight into the world of Nasdaq ETPs. Please let us know which topics and strategies you would like to hear us discuss directly on Facebook. So let's kick this off. Eric, ETP trading overall continues to increase in popularity. So explain to us why millennials are increasingly turning to this product.
Yeah, I think a few reasons. If you look at millennials, they're pretty smart investors. I think that they like the low-cost stuff. If you look at what they actually own in terms of their ETFs, they tend to have the bulk of their assets in sort of really cheap Vanguard or iShares products. So they just, I think, have, over the years, there's been a lot of talk about cost in terms of determining your portfolio outcome over the years and how important cost is. So they got the message. And I think they grew up with ETFs. I think that sort of like the way, I'm a Gen X, so I had the Walkman with the tape. Then I switched to the iPod. So I think other generations are doing that. But millennials, they just grew up with the ETF. That's what they use. Some of them have never owned a mutual fund. So a lot of them will own Vanguard in terms of the ones they have their bulk of their assets in. But then they're interesting. They will use some really sort of exotic stuff for trading. They're popular. They like to use leveraged ETFs. One of their popular ones is a triple leveraged oil. They also do some individual stock investing. So I think that for them, they are still young and they like to experiment with trading and look at their phone, see something that's performed that good that week or that month. And I also think ETFs do fit into the technology they use very well.
Right. And
a lot of them like robo-advisors. Robo-advisors predominantly use ETFs to do their allocation. So that's another way that millennials have a lot of their assets in ETFs is through the robos.
Well, let's talk a little bit, what's the difference between an ETF and a mutual fund?
Oh, there's a lot. But just very simple, an ETF trades on an exchange. And the key part of an ETF, and this is my book, I equate it to the flux capacitor from Back to the Future. I'm not sure if you remember that movie.
Do any millennials? No, I'm the same age as you, so I'm not sure if the millennial crowd would get it.
I almost don't even quote Star Wars anymore because that's how, some of the millennials haven't seen anything. It's scary, honestly. But anyway, that's sort of like the heart of how the time machine works. In other words, the ETF has something very special called the creation redemption process. You hand in the basket, and the issuer gives you back shares of the ETF. That's an in-kind back and forth. That allows for arbitrage. It allows the ETF to trade. It allows it to not have capital gains. That function is a huge difference than a mutual fund, which sort of sits over here. You give it money. It takes your money and buys stocks with it. So it's a different kind of setup in multiple ways. But the main things is it's liquid. It's usually typically cheaper. You can trade it whenever you want. There's hardly any ever capital gains issued, which is something that annoys people about mutual funds. And they cover a lot of different areas. So I think those are some of the main differences.
Okay, so I love my iPhone. I love my iWatch. So I want to invest in Apple, but it's a capital intensive stock. It would cost a lot of money to own even just say one round lot, which is 100 shares. What ETF could I get into to have the exposure to an Apple, a Microsoft, an Alphabet?
Sure, so when you talk about the tech area, there's 45 tech ETFs. And I've been through all of it. In fact, in the book, that's an area I actually open up and bring you through all the dilemmas you face when picking one. So like the Qs, right? That's the biggest tech ETF by far, even though it's not totally tech. It's kind of the Qs is kind of a
mixture of other
yeah,
sectors.
but Apple, I think, is what, an 18% weighting? So you better love Apple if you buy the Qs. And then from there, you go to like XLK, which might have a 15% weighting to Apple. That's the S&P one from Spider. But then as you go down, their Apple weighting will differ. There's some smart beta products that weight on fundamentals. So Apple might be a 5% weighting in there. Then you get to, there's an equal weighted Qs that we were talking about earlier. That has Apple at a 1%, along with every other stock is a 1%. So you get the Nasdaq 100 equal weighted. That's for people who think, yeah, I want a little Apple, but I don't want to go crazy. So just like soft drinks, there's a flavor for whatever you're looking for. And within tech stocks, it's interesting because there's some old school, I call those old school, tech and Microsoft at this point. Apple and Microsoft. Right. But those are the companies that are in the bigger ones. But there's a new breed of tech ETFs coming out that track cybersecurity firms, ones that track social media. That's probably a big one with the millennials. That won't have Apple at all, but that'll have companies that might not be in the big tech ETF. So tech is a space where there's this bottom layer. There's a video game ETF where you find a lot of emerging tech. And those are other ways that I think people like to play tech. But typically, they'll just pick one of the big ones. And in there, you're going to get 100 or 200 tech stocks. And that is diversifying your risks. So if Apple were to have just a horrible launch of a product, stock goes down 20%. Right. The ETF will barely feel it because you've got 100 other stocks that are going to offset that fall. So that is a big, reason people use funds in general or ETFs is that they're diversified.
Well, it's good because millennials, again, they like to set and follow trends, and also gives them the flexibility to trade and have more control over their portfolio. By the way, for those of you on Facebook, write into us and let us know what ETFs you own, whether it's long or short, so we can kind of follow along with the series and make sure that we are following along with the trends that you're setting. But Eric, let's get back to the book. Tell us a little bit about it, and how did you end up into the ETP world?
Right, so the book, it's called the Institutional ETF Toolbox, which I admit is kind of a boring sounding name, but it fits. It's really good. It's a look at, but it's not that technical. It's a really conversational book. You could use it as a primer. And I wrote the book just because there was a few books out there, but they all did like a quarter of what I wanted. So this book, I think, covers the whole thing. It covers everything from trading to asset allocation to new products to how the ETF industry was started. So it just covers everything, and it talks a little bit how some of the bigger investors use ETFs, which is interesting. And the reason I got into ETFs was I was a data analyst at Bloomberg covering mutual funds, and the woman who covered ETFs in 2006 went on maternity leave and never came back. So I got handed ETFs, and I remember looking at them, and if you look at ETFs relative to other fund types, say hedge funds, closed-end funds, mutual funds, you quickly realize that this product type, this structure, is about 5 advantages past any other fund type. It reminded me of the MP3 in the way you're like, this thing's really going to change everything. And people have called the ETF a technology, but that's how I got it. And so as soon as I got maybe a year or two into it, I was like, this could be a big deal. Let me really sink my teeth into this. So I became sort of an expert early within Bloomberg on this topic. Right. Now I write research on it.
Well, it's really interesting because the ETF history itself was really, it was a product that was created to help institutional investors. Those are large trading desks. And I think inadvertently, at the time, they didn't even realize that it was going to be one of the most popular traded retail products out there.
Yeah, believe it or not, the U.S. government came up with the idea for the ETF inadvertently. They didn't mean it, but after the '87 crash, futures really were sort of the culprit, and the SEC was looking for a way to kind of keep futures in Chicago and allow people to do basket trading in New York under the SEC. Long story short, they said if only you could basket trade with one product instead of hitting sell on 500 stocks, that would really help create a buffer liquidity-wise. And maybe the '87 crash wouldn't have happened as much. So that was just an idea. And then 2 guys at the Amex saw that on page like 400 of some post-mortem on the '87 crash and thought, wow, that's a good idea. We're in 3rd place after Nasdaq and NYSE. And they thought maybe we can get some more volume if we create this product. So they combined an idea on commodity warehouse receipts. I won't go into the details, but they sort of, like any technology that's born, it had the right mixture, and it came out at the right time, but then they had to sit through the SEC for 5 years in registration. So you think the Bitcoin ETF was sitting there long at 3 years. This was 5. Finally, in like '93, SPY comes out. Doesn't do much at first. Then when the '90s rally kicked in and people started to get, there were some people who were real believers in it, and it just kind of took root. And then boom, it never looked back. And then now the structure's been copied the world over and trades on 60-something exchanges. There's 7,000 products.
Right.
It's really sort of like, I think, blooming at this time.
Well, let's wrap it up with this. Do you continue to see growth in the industry?
Yeah, so last year they took in more flows than ever before. Every year they seem to break a record, $286 billion. I do see growth, and also the product count. On average, 3 to 4 new ETFs launch every day in the world, almost 1 a day in the US. So there's this huge flurry because if you look at all the assets, Vanguard's index funds are taking all the mutual fund assets. That only leaves ETFs. So that's where the bulk of the money is going. So you see a lot of issuers coming in, issuers that took a while to come in, they're coming in. So I think you've got distribution channels, big, deep-pocketed issuers, and they're all finally going, okay, this isn't a fad, this is where it's going to go. So, and investors like it. ETFs get a lot of repeat users. They use them a little bit, and they find they use them more after that, like any technology, really. So I think the future is pretty bright for now. There's a few little things that I think we worry about, but I think all in all, it's the best vehicle for investing, at least in the current environment.
All right. Well, thank you very much, Eric. And Eric will be back with us in April for our first quarterly update. Thank you for checking us out on a Friday afternoon. I'm Jill Malandrino, Global Markets Reporter for the Nasdaq, and this is Trade Talks.